Let's stick with the banks here and see what the chart master has to say about Wells Fargo. He's got not one, not two. He's got 5 charts that point to more trouble ahead. Carter, what are you looking at?
Hey, team, how are you? Well, it is a problem, and we know that the market's rally has been on borrowed time, postponing the inevitable, and things like Wells Fargo are lurking. But let's look at the 5 slides in particular. The first chart is that of the BKX, and you can see after the plunge that nice counter-trend rally, but that's often what's called a bear flag, and then you break down through the lower band of that channel. Now, put that in your mind's eye, and then take a look at Wells Fargo, and Tim just touched on this. Wells Fargo could never actually flag. It never even bounced, and then has now made a new low. So whereas the overall group was able to stage a bounce, Wells Fargo, no bounce whatsoever. Now, here's a comparative chart. Number 3, it's just the market we know is basically UNCH, 12-month period, versus the BKX down 35, and then you've got, of course, Wells Fargo down 49. Weakness begets weakness. That's the nature of momentum, both to the upside and the downside, in this case, the downside. The fourth of the 5, what we know, look at this sell-off. This peak to trough so far is down 63%, and that's compared to the financial crisis sell-off of 82. And I think there's more to go. Ultimately, I think Wells Fargo is going to touch 19. It closed the day at 22.53. Last chart. And this is the entire financial sector going back to the peak in '07. And this is the real problem, that the entire financial sector could never actually get above its '07 high. Think about how far we are above our '07 high for the S&P. Financials are the transmission mechanism for the whole system, the economy. Something is wrong, it's been wrong, and it's still wrong.
Carter, always great to speak with you. Thank you. Guy Adami, pretty dire charts from Carter Worth.
I wish I was able to view the 5 of them, but as you know, it's very difficult for us to see anything where we are. But this too shall pass, as they say. But listen, Carter's been steadfast. Dan has been as well. So I am in agreement. I want to say one thing, though. Karen brought something up. You know, she mentioned being short HYG, and I think you said or she said, you know, it's not really working out. And it struck me, you know, Karen's about as disciplined a trader investor as you're going to get, and that HYG should be working out, but for the fact that, you know, this money is poured in from central banks as artificially disorganized markets. So there is collateral damage for the central bank's activities, and they come in a form of people trying to do the right thing and not being rewarded for it. I know that's somewhat wonky, but I think it's important because the collateral damage and the unintended consequences of these Federal Reserve activities are broad, and that's just one of them.
Dan?
Yeah, I'll just take Carter's charts and Guy's commentary a step further. Obviously, the weakness in the banks, it's probably warranted. It's saying something about where the economy is. It's probably saying what the next 10 to 20% in the S&P 500 are. But I would tell you equally concerning is the crowding in mega cap tech. And I know you guys covered that off the top yesterday, where you see Microsoft, Apple get back to their prior highs and be rejected. Google back to a prior level where it was rejected in January. A stock like NVIDIA, which trades at almost 15 times sales, is up 33% on the year, and it's trading yesterday. It was at an all-time high. There's some insanity going on here. So I would say the weakness in financial stocks, in banks in particular, and the strength in mega cap tech are equally concerning when you think about where we are right now relative to just valuation in the market relative to where we are in this economic cycle, which I suspect is going to be a deeper and longer recession than most people think and what the market is pricing right here.
All right, we got some breaking news here on Fiat Chrysler. Phil LeBeau's got the latest on that. Phil.
Melissa, Fiat Chrysler and PSA Peugeot. Remember, they're in the midst of putting a deal where they merge companies. Well, both companies have announced that they will be suspending their 2020 ordinary dividend payments. Now, for Fiat Chrysler shareholders, that ordinary dividend, 70 cents a share, comes out to more than $1.1 billion for the company. That was supposed to be paid out a week from today. Well, because of COVID-19, both companies are saying, no, we're not going to be paying those dividends out. We should point out that both companies are also saying this is not going to impact the plans to merge the two automakers. Remember, as part of that merger agreement, they have agreed, each has agreed to pay out a special dividend to shareholders of about $5.95 billion. So again, both are saying that that merger continues on pace. We have yet to see the Fiat Chrysler shareholders vote on that merger proposal. That's likely to happen in the next month or so. But again, both Fiat Chrysler and PSA Peugeot suspending their ordinary dividend payouts. Melissa, back to you.
Phil, thank you. And the stock of FCAU is up 3.6%. Tim, is that because the deal's still on track and that special dividend is going to be paid out eventually? So give up the smaller dividend, go for the special.
I think that's right. I think people want to see that deal close, and then ultimately, keeping as much firepower and drawing in liquidity is something we're seeing every other company doing. So where you can do that and where it's not obligated, I think they should be doing that. And remember, regular dividends are giving money back to shareholders. That's prudent at a time when the company doesn't need the money. I mean, ultimately, it's a disbursement. This is not a time to be doing that. If you owned a business, you wouldn't be doing that. So I don't see why they would be held to task for that. This merger is something people want to see get done, and I think that's the reward here in the stock price.
And obviously, this is you're seeing their scroll in front of you, suspended dividends, dividends that have been cut in this environment. Karen, I suspect that you would think that there might be more to come, especially if we think that there could be another wave, there could be, hesitation after reopenings, depending on what happens, et cetera. That the worst is not over when it comes to people who are relying on dividend payments.
Right. I think that's true. But I agree, Tim. I think it's the prudent thing to do. They should do it. I mean, and you kind of, we talk about companies sort of getting a free pass if they withdraw their guidance now. I think a lot of companies are going to find it a little more palatable to cut or suspend their dividend. Think about it. Disney, right? Disney not paying their first half dividend. That's kind of amazing to me, and yet we sort of accept that. It's the right thing for them to do. If capital is at all an issue, you have to save it.
All right, coming up.
Save the capital, I mean, not pay the dividend.